This morning, we issued an initiation report on One Group Hospitality, symbols STKS. Our initiating was an outperform rating and a $5 price target. The One Group is an international restaurant company that develops and operates upscale and polished casual high-energy restaurants and lounges, and also provides hospitality management services for hotels, casinos, and other high-end venues, both in the U.S. and internationally. Their primary restaurant brands are STK, which is a high-end steakhouse, Benihana, Japanese steakhouse, Hibachi, Kona Grill, and RA Sushi. They're a leader in what is termed vibe dining. Vibe dining is characterized by a quality culinary experience complemented with an engaging social scene, such as DJs, dancing. Basically what they're trying to do is get people to not only come in and have food, but also to stay there for longer periods of time as opposed to getting up to go someplace else. In 2024, they did a transformative acquisition. They acquired the former owner of Benihana and RA Sushi. Acquisition more than doubled the run rate revenue and adjusted EBITDA, but also diversified the company's customer base, location, price points, experience, etc. We expect Benihana to boost overall company profitability. One of the key areas here is there's significant white space growth potential, both domestically and international. They believe they can get the potential of over 600 locations, which is a significant increase from the current 168 locations open. The company itself uses a capital-light strategy, which we think will help them accelerate their expansion plans. They employ a cross-section of ownership models, including corporate-owned, franchise, management agreements, licensing. They are accelerating the franchising strategy for Benihana. That's the one they see the most growth from. They note strong interest for franchisees looking to diversify their portfolio. They're currently negotiating numerous development agreements. So, the overall casual segment is expected to continue to grow at over 5% compounded annual growth rate from 2033, going from, roughly 300 billion to over 500 billion worldwide. The company's had some positive experience in acquisitions. They acquired Kona Grill a number of years ago. I think it was 2019. And, if you look at that acquisition and what they've been able to do, they've more than got back everything they paid for that acquisition. They've increased average unit of sales. They've also increased the returns from that at a nice rate. We think they can do the same here with Benihana. They already identified over 20 million of synergies upon the acquisition. A number of them, obviously, they've already captured in 2024. The rest that we expect to capture in 2025. And we think the company is on a path to grow that total system-wide sales from about $1 billion today to over $5 billion once they open up their over 600 locations they feel that they can get to. We believe they had, sufficient cash flow and the balance sheet to implement their strategic plan. If you look at this was the pro forma 1 year free cash flow, doing roughly 110 million of adjusted EBITDA, and you take out, maintenance capex and interest expense, that leaves them with roughly $60 million for either opening new locations, which they expect to open 5 to 7 new owned locations per year, and or if the environment is not favorable for opening new locations, of using that free cash flow to help reduce leverage. The balance sheet is solid, while there is some high cost debt out there and high cost preferred stock. Total liquidity at year end was about 71 million. But as I said, if you look at their average interest rate on their term loan, that was 11%, a little over 11% at year end. And the Series A preferred stock has dividends that begin at a rate of 13% per year. So that is something that they are aware of. And again, with the free cash flow, they should have sufficient capital to start to reduce the outstanding debt when necessary.